Since 1970, Malaysia's budget has been in a deficit in all but 5 years, regardless of how good or bad the economy's performance during that particular year. The struggle in balancing our budget is shown to be structural in nature. This proves that there is an apparent lack of fiscal discipline in our economy.
But first, let's look back at the past and get a clear picture of how Malaysia has been doing with regards to government revenue and budget deficit 10 years back. The graph shown is the total revenue that Malaysia's government earned from 2008 until 2018. From the graph retrieved from Malaysia's treasury, we can see many trends during the past 10 years. In 2010, total government revenue had risen significantly for 6 years until it reached its peak in 2013 with an increase of 65.44 billion ringgit as compared to the total revenue in 2010. Government revenue then falls at the lowest base 212.42 billion ringgit before it rises again in 2018. Next, we move to the graph that shows the size of government revenue to the GDP of Malaysia. This data explains the government revenue ratio towards Malaysia GDP from 2008 until 2018. In 2008, the total government revenue covered 21.6% of total GDP. This ratio slowly decreased as the ratio of government revenue only covered 61.1% of total GDP at the end of 2018. The other important determinant in measuring the revenue base of Malaysia is the budget balance. The data show is important in evaluating the difference between total revenue and total expenditure of the government throughout the year. In the case of Malaysia, the government always faces a budget deficit as the amount they spend is always higher than the amount they earn. This graph shows the size of Malaysia's government budget deficit to the total GDP. From the graph, the budget deficit of Malaysia keep decreasing from 6.7% in 2009 to 3% in 2017. There was a decrease of 3.7% during this 7 years period of time. The budget deficit rises in 2017 to 3.7% to the increase in government spending 2018. According to Trading Economics on their website, the budget deficit is forecast to increase to 6% by the end of 2020. In the long term, Malaysia's budget deficit is projected around 5.5% in 2021 and 5.3% in 2022 of the GDP based on the econometric model.
There are two types of taxes that we all should know. Firstly, direct taxes. A direct tax is a tax that is levied on a person or company's income and wealth. The tax is paid directly to the government, and examples of direct taxes are income tax and real property gains tax. On the other hand, indirect taxes is referred to as tax excised to a person who consumes the goods and services and is paid indirectly to the government. Examples of indirect taxes are GST and the SST. There are two issues with direct taxations. We have tax avoidance and tax evasion. So tax avoidance, unlike tax evasion, is legal and must be differentiated from tax evasion. Tax avoidance may occur through the use of specific provisions found within a taxation system. Tax fraud, which may take place in Malaysia, are false reporting of income, using a false identity for tax purposes, failure to file an income tax return, refusing to pay taxes, or claiming personal expenses as business expenses for the purposes of reducing one's tax obligations. The Lembaga Hasil has reported that in 2010, additional taxes and penalties amounted to about 1 billion ringgit Malaysia of the finalized audited corporate tax cases. With goods and service tax repealed on 1st September 2018, the RMCD is actively conducting audit to expedite GST refunds to businesses. And as of February this year, 7.8 billion of GST refunds are still owed to businesses. The Customs aims to complete all GST audits and refunds to businesses this year. Common issues during GST audits are that firstly, documentations are not available, reconciliation of forms submitted compared to companies' accounts, and the difference in interpretation of laws and regulations. In addition, With the reintroduction of Sales and Service Tax SST 2.0 in September 2018, the Customs has started enforcement in conducting audit since early 2019 to ensure compliance of the businesses. Although the SST 2.0 is generally similar to the previous system, there are still differences that businesses should note. Some of the common issues we observe during SST audits are that businesses are not aware that they are being auto-registered by Customs. Secondly, businesses use SST 1.0 model for SST 2.0 implementation. Thirdly, businesses did not keep up to date with the latest changes. And finally, the difference in interpretation of laws and regulations with Customs. Other miscellaneous issues on tax includes the fall of crude oil prices, which leads to lower taxes on our petroleum imports. The crude oil market crash between 2014-2016 has resulted in a decline in Ropi collection to as low as Rm 8.42 billion, and this trend is also happening nowadays with the global pandemic going around. The hidden and informal sectors, also known as the shadow economy, can also generate substantial tax revenue. However, the nature of the shadow economy is undocumented, so the government cannot properly gauge how much tax revenue can and has been generated from the shadow economy. Did you know that the shadow economy has generated around 21% of the total Malaysian GDP last year, and that is around 300 billion ringgit worth of tax collectibles alone?
However, as the global pandemic hit the world, the scenario completely changed. The Malaysian government's revenue is projected to drop by 14% in 2020 as a result of lower tax collection, according to the Ministry of Finance in its Fiscal Outlook 2021 report. With weaker economic activity affecting business and individuals' income with lower crude oil price assumptions, direct tax is expected to decrease by 14.6%. Sales tax collection is projected to reduce by 21.4%, with indirect tax falling by 19.4%. In such case, the Malaysian government has planned to take actions for 2021 as an expansionary budget has been raised to a record 322.5 billion ringgit, where 69 billion ringgit is allocated for development spending and 17 billion ringgit for a COVID fund. As the number of stimulus packages increase, Malaysia is expecting a 5.4% fiscal deficit of its GDP. In such a crucial scenario, one might ask, so what can the government do to combat this issue? As we have figured out the issues of Malaysia's government revenue, we need to understand the deep-rooted challenges that Malaysia faces when it comes to broadening the government revenue base. Fiscal management. In a country with a history of economic crisis, as for instance in 1998 and 2009, it is expected to have large budget deficits. However, even when the economy was experiencing growth of 6% and oil prices were rising, the Malaysian government's fiscal deficit remained large, indicating that it is no longer a cyclic issue, but it is in fact structural. High subsidies. Though they are often intended for the poor, subsidies do not always end up helping the poor. Between 70 to 72% of the fuel subsidies are estimated to benefit the urban rich. Like in reports of 2018, it showed that road users enjoy subsidy of close to 6 billion a year. Government balance sheet that here showed that revenue it earns related to vehicles is about the same as the subsidies given to road users. Again, in 2017, annual road tax collection is reported to be under 100 million because only 19 million out of 25 million vehicles owners pay road tax. To quote the Edge Market Malaysia article, Malaysians cannot have higher subsidies and lower taxes at the same time. The country will go bankrupt if government finances are managed that way. Lastly, tax competition. Lowering personal and corporate tax rates to boost regional competitiveness is one of the many things globalized countries like Malaysia needs to do. According to IRB, Malaysia's income tax rates are competitive. In 2018, Malaysians with taxable income within 20,000 to 70,000 had personal income tax rate reduced by 2%. With taxable income between 20 to 35,000, personal income tax rate reduced from 5% to 3%. And for 35 to 50,000, the tax rate lowered from 10 to 8%.
After we look at the issues and challenges of Malaysia to broaden the government revenue base, here are some suggestions of the strategies that Malaysia's government can opt to increase their revenue base. As tax is the major contribution of the government revenue base in Malaysia, where about 50% of federal revenue comes from individual income tax, 7% come from corporate income tax, and another 36% from payroll tax. Therefore, the government can increase the revenue base by playing with the tax policy measure. The first strategy is that policymakers can modify existing tax policies such as increase the tax rate that apply to specific products such as cigarettes and other products which can harm society or give negative externalities to the community. In the context of Malaysia, recently, Tengku Zafrul has announced an excise tax on all tobacco products and electronic cigarettes at 10% rates by imposing tax on drawbacks on all imported cigarettes for the purpose of transshipment and re-export to increase government revenue base on the budget 2021. Secondly, the policymakers also can increase the government revenue without playing with the tax policy measure such as collection of rents. Federal government can appoint an agency to collect rent for existing assets, for example, through land leases or property rentals. Public sector organizations with excess capacity and do not seek to dispose of these assets can leverage this capacity to generate increased revenue through rent collection. In the United States, one government organization applied this strategy, which was named General Service Administration or GSA, which managed to get $500 billion in federal assets. They charge rent to over 100 federal agencies and numerous commercial clients for use of these assets. Their aims are to increase revenue for GSA and reduce costs for other agencies as well as improve the federal utilization of space. In the context of Malaysia, this strategy did not seem yet to be applied, but Malaysia can make it possible.
One of the improvements that has already been proposed is by RTBA Malaysia in order to curtail the tobacco black market, which costs the nation RM5 billion annually in uncollected revenue and forms a significant portion of the RM300 billion shadow economy. They have put forward a 4-point proposal to the government. The points are: increase funding to the relevant enforcement agencies to recruit more personnel, conduct advanced training, and provide better equipment that enhances performance and safety. Review price mechanism and excise structures, establish funding for a multi-agency and multinational task force to combat the tobacco market, and create an anti-black market fund to encourage whistleblowers. This fund can also be used to upgrade the reporting process to improve response time and quality of action. As a whole, Malaysia needs a comprehensive reform of its tax framework if the government wants to be in a better fiscal position and at the same time ensure to achieve sustainable and inclusive economic growth. Some of the additional improvements could be removing ineffective tax incentives and exemptions and pursuing tax administration, tax policy, and technological reforms simultaneously.
The Malaysian economy is expected to contract by 3.1% in 2020 according to the World Bank. There has been a slowdown in the aggregate level of investment. Thus, one of the ways that the economy could be revitalized is through the increased government expenditure. Malaysia can also reduce the cost of capital, helping firms to increase the level of investment and increase overall output in the economy. By lowering the rates of interest, governments can also borrow more and seek cheaper capital funds in order to drive the local economy, as the global economy will take time to recover. Cash transfers will also help drive private consumption so that there is a jump in aggregate demand in the economy. All these factors would help revitalize the economy, as the economy can't rely on growth coming from other global nations. It will have to rely on its local factors to production to drive out.